Investment advisors don't deserve your fees. Man, I'm telling you. All right, let me just go on to this. I'm going off on a tangent here. So I'm driving back one of my kids from school. It's in the morning, so I usually take, I usually get up at 5:30. Spend about an hour and a half to 2 hours just doing my basic research and reading and whatnot. And I got fired up on some articles I was reading. So I was reading an article by a guy named Larry Swedroe who talked about the factor-based investing, and he basically said, look, there's some factors that are a myth, some are right, and we can look at a couple of them. What factor model means is you have the total market as a whole, right? And that's your beta. So the market returns 1, you return 1, you have a beta of 1. I mean, it's just it gets preposterous, but that's what investment advisors use to show their chops. But there's other factors as well that gives you outperformance historically, and one of those factors is small cap and then value tilt. So the French Fama model of Ken French and Eugene Fama of, I think they both won Nobel Prizes if not mistaken, but they're basically academic titans, and they say, hey, if your small cap value tilt has outperformed historically. Now, what Larry Swedroe's article was on is that is a good factor that you can absolutely take to the bank. And the reason for that, as I talked about the other day, is just more risk. I mean, small caps and value, the reason they outperform is because they're riskier, and they should prevail over time. More risk equals more return. Now, Larry did say, look, over the last 10 years, that didn't happen. The total market beat the value in growth tilt for sure. So a lot of people are saying, oh, that's not true. Now, so where's this person going? All right, anyway. So some people, some naysayers say, hey, Larry, what happened to your value tilt? What happened to the French Fama model? It did not work in the last 10 years. And what Larry Swedroe says, yeah, it didn't work in the last 10 years. It did work in the 10 previous. In fact, has worked a significant proportion of time. I think he said like 44% of the modern era of investing, there was a pretty significant value tilt where value outperformed just total allocation to investment S&P 500 or the total stock market. And so there's enough of value tilt to recognize that most likely if you orient your approach to value investing, you'll probably outperform. And I absolutely agree with that. I don't have any qualm with that whatsoever, and for reasons I've stated in previous videos, which I won't get into here. But the interesting thing is Larry would compare the DFA, Dimensional Fund Advisors, to the Vanguard total markets to get to basically give you the assessment of the value tilt historically using DFA, which is where French and Fama, they started a firm. I don't know if they started, but they're definitely the academic chops behind this firm called Dimensional Fund Advisors, for Ken French and Eugene Fama. And what they've done is they said, look, we believe in a value tilt. We're going to either join in or start a firm called Dimensional Fund Advisors, which will have a value tilt inherent in all its portfolios. And so Larry compared DFA to Vanguard, and yeah, that's fine. I got no problem with that. And he said, look, DFA has outperformed because the value tilt has remained steady. Other factors had not. All right, no qualm with that. The qualm I have, though, this is not so much for Larry, it's just that you can't buy DFA directly. You can't. You have to go through a fund advisor or an investment manager. You can't go to DFA's website and say, how do I do it? And they'll say you got to do it through a manager. Now, you may or may not have access to DFA, a small sample of DFA funds in your 401k. I highly suspect you won't. Some 401ks might, but it might be 1 or 2 share funds, that's it. So for the average Joe, you have to go through a fund advisor to get DFA. The fund advisors aren't free. So we know for a fact when you compare DFA to Vanguard, if you're just looking at total return versus total return, that's deficient. You got to look at total return of the fee that you're paying to DFA, net of the fees you're paying to the investment fund manager. So if I'm looking at Vanguard, say it gives me 10.5 and DFA gives me 11 gross of investment fees, but I'm paying 1% investment fee, it's 10.5 minus a 1% investment fee. So it's just, this is what John Bogle talks about in his books. You can't, I mean, if you got to slice, you can't slice and dice it like this. So anyway, so I'm looking at DFA's website. So, okay, how do I, hold on a second, okay, how do I pick a guy I want to manage my money? Because I do believe in DFA. I like the value tilt, blah, blah, blah. And let's just say DFA on average charges 25 basis points for their funds. All right, so I know I'm in the whole 25 basis points relative to Vanguard, maybe a little bit more than that. So I go to DFA's website, it says find an advisor. I type in 3004, that's my zip code, and I get a bunch of advisors. The first website I pick by random, I go in there, and what do? They say they're fiduciary. They say they're evidence-based. They say their academic investment, their investment theory and philosophy is based on academics. And then they say that 94% of investments return is due to asset allocation, as if that's science. And they actually use the terminology science. And this, I tell you, man, this ticks me off something wicked. There is a study, and the name's Binder, if I'm not mistaken, back in the 80s, looking at pensions. The Binder study is what they use to determine what determines investment returns. And they say in their study now, 94% of the variance in returns is due to asset allocation. Asset allocation is stocks, bonds, and cash. How much do you have in stocks? How much do you have in bonds? How much do you have in cash? In no way, under no shape, matter, or form, did Binder's study say 94% of your investment returns are due to asset allocation. They could not be clearer. I find it so infantile, elementary, and actually misleading that these fiduciaries, basing their study, their portfolio management styles on science, will use that study as a way to show, hey, we're not timing the market because timing the market is foolhardy because 94% of investment returns are based on asset allocation. And then, I'm just telling you, so I'm looking at this, and right before that, they say we're using Nobel laureates. I can't remember if they say Nobel laureates, but they're saying we're using science, investment, or evidence-based by French Fama, and they, the research, the academic theory behind this, as if they're so, there's academics are so true to the nature of investing that you just trust them because they're science. And this appeal to authority infuriates me, especially when the appeal to authority is actually I don't want to get into it because I'll tick people off. There's other science things that have the same appeal to authority. And it just infuriates me because it's wrong on every single stretch of the imagination. And so in investment, we're saying we're appealing to authority being academics, the literature, Nobel laureates, the evidence base, as opposed to just some broker who's throwing darts at a stock chart. But they're not, because they're completely bastardizing the Binder study. And which was, I hate to say it's 30 years ago anyway. It's done on pension plans. So let's just look at this. If 94% of your returns were based on asset allocation, explain to me. I buy GE in 1998, you buy Apple. Which did better? All right? I buy Pets.com in 2000, you bought Amazon or 1999. Which did better? They're both stocks. So if 94% of our returns are based on exposure to equities, explain the difference there. Well, those are individual stocks. We're looking at asset allocation as a whole. But they don't say that. They don't say that. They say allocation drives 94% of performance. Folks, this is complete. I hate to say it's fraudulent, because I don't even think it's fraudulent. I think it's ignorance. They don't take the time to do their own research. It's like you're doing a fantasy football team and you don't want to take the time to do your research, so you're just going to listen to Mel Kiper, all right? And it's the same thing. Well, he knows what he's talking about because he's on ESPN. Does he? Does he know what he's talking about? I find this to be, this is exactly what's happened. Well, they're academics. I'm just some guy. So, but you're misrepresenting what the academic state. On top of that, to say that there's evidence-based, there is no evidence-based. You can't base evidence on future performance based on past performance, and yet you're going to hold yourself as a fiduciary. And I scoured the website to find the feed. I couldn't find it. So why am I so fired up about this? Because I'm reading another article this morning about this dude, and he's talking about this guy, talking about my man Alan Roth. He's basically saying Alan Roth is violating his fiduciary duty and stuff. I'm sitting there thinking, this is insanity to me. That'd be like saying Jack Bogle is violating his commitment to investors. And I'm looking at this guy's for his what's called ADV, your disclosure on the SEC website. Can't find a website. Can't find any kind of mechanism of how to elaborate how much he charges for his fees. So I have to look at his ADV. Well, no one does that. And it says he charges 2%. I'm like, how is that fiduciary standards, man? And then on top, that's a wrap fee as well. And I assume that if it's a wrap fee, there's more fees on top of it. But I don't know, because there's no website I can find. Infuriates me. These people don't deserve your money. They don't deserve your money. If they're that ignorant, and again, ignorant means they don't know. And I give them the benefit of the doubt. They don't know. Ignorant doesn't mean they're stupid. It just means they don't know. But the thing that ticks me off is if they are that ignorant and yet using this appeal to authority to appeal to you, to separate you from your money, that's bad. And that should not be tolerated by people on my side of the coin who want the investment advisory and the financial planning business to succeed. It certainly shouldn't be tolerated by you with your hard-earned dollars. It shouldn't be. And yet millions and millions and millions of dollars are being managed by these people who are holding themselves out as like they're using some kind of model that's out there, but they're not. They're completely not. They're misrepresenting things. They're not using the fiduciary standards to say explicitly their transparent fee, and yet they're saying they're very transparent. It ticks me off. Don't let them get away with it. You have an obligation to watch your bottom line. If some guy sits there and goes, we are academics, we use evidence-based, we use academic approach, and 94% of returns have been proven to be due to asset allocation. No. And then you say, we're using academic Nobel laureate French family model. And then you just ask them, well, how come the model didn't do as well as the last 10 years? Now, hopefully they have a ready experience, a ready response. Well, it didn't do as well as the last 10 years, but did 44% or whatever, half the time is outperformed enough now historically that we think is worth the allocation to that approach. We think there's enough of a history of outperformance to warrant to take that risk going forward because it is more risky. And if you say, okay, that's great, it did outperform, let's say, not even the majority of the time, but enough to warrant the risk, why should I take the risk if it hasn't performed over the 10 years? And if they say there's no more risk on the value tilt because it's academic or evidence-based, say no, there is more. Inherently, there's more risk. Value means the prices are lower. That's all there is to it. The prices are lower for a reason, because it's riskier. Small means it's more risky than large. That's why it's small. So if the risk doesn't come to fruition, i.e., you can actually exploit the risk in a diversified portfolio, which you probably can, over the longer term, you should probably outperform. But we don't know that for certain, and we're living right now in the last 10 years, it didn't happen. So, all right, to end this diatribe, these guys don't deserve your money. You deserve someone who says, this is what I charge, and this is why I do it, up front, and take it or leave it. None of this hoity-toity appeal to authority. Well, the investment academic world says this, or the Bender study, and I guarantee these people don't even know what the hell the Bender study is. None of that. If you're going to an investment advisor to pay him, that guy should have the chops. I want to see your research, my friend. I want to see what you've written on this stuff. And I mean, I'm telling you, if they haven't written on the stuff and they're just using other people's stuff, that's no different than. I'm telling you, because in the industry, in fact, what happens is you'll have these wholesalers who go into investment firms, buy them lunch. They used to take them to dinners and, hell, back in the old days, strip clubs. And if the more money they gave to the investment firm, the more it was a quid pro quo, all right? You give us, we'll come in, buy you lunch, show you our techniques, and then if you put money with us, we'll give you more stuff. I guarantee that's still happening, maybe not to the extent it used to be in the old days. No. That's what a lot of these guys essentially are doing. They're saying, well, we are so smarter than everybody else, we don't even need to do that anymore. We just use the academics research. And don't fall for it. Don't fall for it. All right, we'll see you next time.